It's been quite the journey, buddy. Quite the journey.
Yeah, and I thought I was just going to retire into obscurity in 2020. And then COVID hit, the world turned upside down, everything stopped, and Bitcoin presented itself. And
you know, what I find fascinating, a lot of people don't know this, is you discovered Bitcoin not in 2010 or 2014 or 2018, but as a result of COVID. I remember being with you in Miami, you're telling the story, and I'm going, that's incredible.
Yeah, I heard about it back 8-9 years earlier. I think I tweeted very famously in 2013 that it was interesting, but I thought it would go the way of online gambling and get banned. And then I forgot that I tweeted that, and then in August of 2020, I tweeted that I bought $250 million of it. And at that time, it didn't occur to me that I was the first person to publicly announce that I'd spent that much money. Then, you know, on my Twitter, or my X account now, I have this phrase, you know, Bitcoin is a swarm of cyber hornets. And the cyber hornets are all the people on the internet, like the person that made that video. That was not me, I did not make that video.
Of course not.
Like, but they're always doing that. And so one of the hornets scanned every single thing I tweeted in my entire life, and they dredged this up like, ha 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 ha, you know, look how much money you lost, you could have bought it $100 or something. And I just kind of recycled the Bitcoin trope, which is I said, everybody gets Bitcoin, the price they deserve.
That's true. You know, speaking about the ups and downs and so forth, you have extraordinary tolerance for risk and resiliency, I think is the right word. I drudged this up. On the left is an article from 2000, lost $6 billion in a day. And then on the right is actually February, that's the wrong date, 2024, not 2000, where you made $700 million in a day. How do you sleep at night with that kind of fluctuation?
You just gotta have a mission, right? Yeah, you gotta have a mission in your life, so you can't really control the fluctuations in the market. You can control your reactions to them. So in this particular case, my view on Bitcoin is the reason to do it is because it represents freedom and sovereignty, truth, integrity, and hope for the world. And that being the case, it's gonna outlast all of us. So, you know, I'm kind of thinking that Bitcoin goes on long after MicroStrategy's gone, and MicroStrategy, the company, probably goes on long after I'm gone. And you know, my view is, if we're remembered for advocating and accelerating the adoption of Bitcoin throughout the world, then that will have been success, and I don't really need anything else.
It's amazing.
And
you know,
I'll take the beatings as they come or go in order to get to that end goal, because I'm sure it doesn't come without turbulence.
But the conviction that you've had that's guided you consistently, right? Does that go to like first principle thinking of physics here? Of like this is just not going to go down, this is going to go up, there's only going to be so many and so forth. Is that first principle thinking that led you to make this commitment in the face of everybody else questioning it?
I think one of the great things about MIT is that it teaches you to think, and also it teaches you to start from first principles. And the combination of that and aeronautical engineering, where you have to build a machine that will fly through the air or through space by combining, you know, all manner of engineering. I think that makes you confident. My first memory of MIT was the materials engineering professor. He walks out, he says, here's a tile that just burned off the space shuttle, and NASA doesn't know why it burned off, and we don't know how to fix it. What do you think? And it was 18-year-old kids, and we're all 500 of us were sitting in a room, And a guy who's a consultant for NASA looks at us and he says, you know, NASA doesn't know the solution, but what is the solution? Everybody looks at each other, and you can see, first we're all like, well, did I miss the reading? Like was this in a reading? And then you have this dawning, horrifying observation that the answer to this question is not in any book written in the history of the world. And the guy that had NASA with the original problem sent it to a professor who knows more than you know, who's telling you he doesn't know the answer, but he's asking you. And so first you're thinking, I didn't read the reading. And then second, you're like scared. And then some kid in the front row raises his hand and says, well, you know, you thought about changing, you know, the lamination on the composites. And everybody else looks and they're like, the professor's going to call the kid an idiot, right? And we're all afraid of it. And he goes, no, that's a good idea. That's what I thought too. And we tried that, but that didn't work. And then we all go. And then the next kid, you know, raises their hand. And you think, I guess they actually expect us to think for ourselves. And that was how MIT started, and it just continued along that line. And so, if anything, when I left school, when I left MIT, my thought was, you have to work excessively hard. Don't be afraid of hard work, but you can solve the problem, and that's what they do here.
We were classmates together in Unified Engineering, which is probably one of the toughest courses there. The only way to get through it was by working in teams on problem sets. I think I probably cheated off your problem sets more than the other way around.
You're too kind. Let's talk about Bitcoin.
So,
Actually, I want to talk about abundance, Pete. And I have one observation, which is the whole essence of Bitcoin is about creating perfect money and the discovery of what we call digital scarcity as a digital scarcity as a commodity basis for sound money. And another one of the tropes in the community is when money is abundant, everything else is scarce, and when money is scarce, everything else in the society is abundant.
What's the logic behind that?
If you go to Zimbabwe, or you go to Venezuela, or you go to any country going through hyperinflation, when they print the currency collapses. As the currency collapses, everyone in the economy doesn't want to take the currency anymore, and you get ripped back to Stone Age barter. And so, like in Nigeria, this week, the Naira went from 400 to the dollar to 1,600 to the dollar.
Wow.
So in an economy where the currency, I mean, that's a 75% currency debasement in a week. When that happens, and I see you in Nigeria and I want to buy your house, you know, next year, well, the issue is, well, with what? And what will it be worth next year? You'll buy it today, or you won't buy it at all. How do I sign a 12-month contract if the money's going to be worthless in 9 months? So there are no term contracts. How do I trade with you if you have to trade with someone else and the supply chain is 18 months long? Right? When the currency unwinds and the assets unwind, the supply chains break. When the supply chains break, specialization of labor breaks down, the entire economy breaks down. Eventually, everyone has to grow their own food, right? You want abundance, you don't actually grow your own food in your backyard, right? Productivity drops by a factor of 100 to 1,000 if you can't solve this coincidence of wants problem. So you need sound money, and it needs to work across time and space. And the currencies that we use as a medium of exchange, they might be tradable over parts of space. Right now, by the way, it's probably illegal to actually pay someone $1 in Nigeria.
Really?
Yeah, like so.
Just currency controls.
Yeah, capital control. You see capital controls all over the world, especially when the currencies collapse, the capital controls go in place. So you can't trade money, or you can't trade the currency across borders. And of course, you certainly can't trade the currency with your future self 10 years from now. And how do you even trade a currency? You know, in collapsing countries, you'll find nobody wants to sign a 3-year contract because the local currency is not going to be worth the same amount in 3 years. So you have a hard time trading in time with counterparties. or in space. And so the key to abundance is fixing the money problem.
So you have this insight about, you know, digital currency, digital property. How long did it take you from studying this idea to making the decision to buy 250 million worth of Bitcoin?
I started thinking about it, I guess, late March, April. It took about 8 weeks before 4 to 8 weeks of constant thinking before I came to the conclusion it was a good idea. And it was probably, you know, for me to make the decision, I had made the decision personally by late May. I bought $175 million of Bitcoin in late May of 2020.
Personally?
Personally, but that was just me negotiating with myself. And I guess I started probably late March, early April. So that's 6 weeks to get there. And then we have a public company. So for a public company to do something, the officers have to buy in, the outside directors have to buy in, the accountants, lawyers have to buy in.
So I want to take us there, right? So one of your board members, one of your outside board members, great guy, Rick, is here with us today. We'll call him out. But you walk in, what was the process of getting a public board to do this?
Well, in that case, I actually pulled the 3 most compelling videos on Bitcoin off of YouTube. You know, an Andreas Antonopoulos overview of Bitcoin, a debate by Eric Voorhees and Peter Schiff over Bitcoin versus fiat currency as money, probably some other background on Bitcoin. I put those 3 together. It's probably 3 hours of watching. I included some articles, some short articles maybe by some of the Bitcoin OGs. I sent the package off to each board member. I said, I've got some homework for you. It's probably going to take 3 to 5 hours for you to read through all this. Read through all of it, and then I want to meet with you. And I set up one-on-ones with each one of them. And so I met with each one individually. I answered their questions. Then after that, we had a group meeting, and after that, we broke into committees to study different aspects, the accounting, the disclosures, the whatever. And so it was a group process, and of course, the CFO and the general counsel at the time were also heavily involved.
Did they threaten to resign?
No.
Okay.
It was never a question of do it or don't do it. It was an observation that the world had come to a grinding halt. We had $500 million yielding 0% interest. We were our stock had hit $90 a share. The enterprise value of the company was about $60 a share. $60 a share, you know where the stock is right now. And we had been competing with Microsoft for about a decade. And for all of those of you who compete with Microsoft, you have an idea of what that's like. They have every company on earth as their customer, and they can bundle your product into their whatever. So it's not easy competing against Microsoft. We had experience, and we were under pressure from our shareholders. You know, it's like you have half of the market cap of the company is cash. You're earning 0% interest. You're not beating the cost of capital. The cost of capital is the S&P return. So anybody looks at it and says, if you're not getting 8, 9, 10% on the capital, you should give it back to us so we can invest it. And so we reached a point where the company was looking at a fast death. We just sell the company and call it a day. Or a slow death. We keep the cash and the stock is dead money, and that means the stock options are dead money. And that was the time when it used to be employees work for you because they liked the community and the schools and their home, and maybe they were loyal to you because they saw you every day in the office. But think about what happened in the second quarter of 2020 when nobody came to the office and they could change jobs and go work for Amazon, Facebook, Microsoft, or Google without moving. All you do is just repath your Zoom account. And so all of a sudden you're staring at big tech, you know, the big tech companies more powerful than most countries and getting more powerful. And you've lost the human connection. They don't have to move to San Francisco. They can simply take a job, and nobody ever got hired by big tech for less money than they're making working for you. So, from our point of view,
you were on the precipice of a serious.
It's like sell the company or just watch all your employees dwindle. You're going to get boiled off, and after the good employees leave, the product will gradually deteriorate. And you're competing against a digital monopoly that has more power than all but 4 countries on Earth. And so we either do that, or we take a risk. And so we were basically at a point where maybe we should take a risk. Now, having said all that, what really happened there is we deliberated. It took a long time to deliberate, a lot of education. And at the end of the day, we ended up announcing that we were going to do a Dutch auction and buy back $250 million of the stock at a premium coincidental with the purchase of Bitcoin. So we didn't just take that risk. We basically said, we're going to take the company on a path you may not agree with, but we'll buy you out. And so we were prepared to give up half. I had to basically pay $250 million for the right to buy $250 million of Bitcoin in August of 2020. Right? That's the price we paid. That Dutch auction, the stock was about 121, 122. We offered to buy our shareholders out at 140. We gave them 20 days to think about it. We bought the Bitcoin. No company had ever bought that much Bitcoin. And by the way, following that, only Block and Tesla did it afterwards, but it was a very rare thing to do. Of course, Bitcoin cooperated by immediately trading down. We bought it at 11,800 and it traded down to 9,800 or something. So I was looking like a genius again. Buying the top, the Dutch auction ran, but the stock traded above the 140 price after a day or two. Everyone that didn't like the idea just traded out at above 140. We had $75 million tendered. We bought those shares at 140. We had $175 million left, and we bought Bitcoin with that. And so we had basically transformed ourselves into a company with Bitcoin as a treasury reserve asset through that capital markets activity, and it was in a partnership with the outside investors. When you're a public company, you don't just do it. You have to transparently cover.
I just find it incredible, I think the Greek word is the cojones. But to take, it's the action of a leader who's willing to take a big risk that put the company on its trajectory. Because it's so easy to ride a company to the ground. It's so easy just to do what everybody expected you to do. I'm curious, how many folks here in the room own Bitcoin? Raise your hand high. Okay, so the majority of you go home tonight and buy some Bitcoin.
Good for you.
So we had Cathy Wood on the stage last year, and she'll be coming back again next year. And Cathy's prediction was, $1 million to $5 million. And it was a good week, last couple of weeks. And I can understand the decision. Let me back up a second. So Block and then Tesla bought Bitcoin in their treasury. I remember you having some conversations with Elon about trying to get him to step up even further. Why aren't other companies following suit in a major way? I think you made your point extremely well.
No, I think the primary impediment to corporate adoption by publicly traded companies is that indefinite intangible accounting is toxic to the P&L and to the balance sheet. So no company with a healthy business that's fairly valued by the market, or no company run by a management team that doesn't have voting control, would ever adopt indefinite intangible accounting, because what it does is it doesn't just obscure your balance sheet, it also obscures your P&L, and it even mixes investment gains with operating gains and investment losses with operating losses. So it, in essence, renders 100 pages of financials irrelevant. And the current accounting is you can't even pro forma it out. So not only does it make all of your accounting non-comparable across periods, it makes all your accounting non-comparable across competitors, and it also ties your hands with the ability to explain that. So you're not going to see you would do it because your choice was a fast death, a slow death.
Mm-hmm.
And if you're looking at a fast death or a slow death, and if you had voting control of the company, and if you tried everything else, then you would do it. So we were a unique company, a unique place. And by the way, I don't think we would have done it if it hadn't been for COVID. If the world had not shut down, I don't think we needed COVID to hit. You need wars, right? People will say, I don't believe in flying an airplane, and a war hits and they start embracing air power. People will tell you they're not going to embrace, whatever it is until the war hits. So we had a war, the economy shut down, and then we had the central bank take interest rates to zero. But they didn't just take them to zero. They also, we had the head of the central bank give a speech saying, I'm not even thinking about raising interest rates until the year 2024. So they took them to zero and basically signaled they were going to peg them at zero for 4 years. Now, that didn't quite happen, right? A lot of banks wished it had happened. I mean, the people that believed it got caught on the wrong side of that trade, and Silicon Valley Bank and the like crashed because they believed what was said. But the point is, there was a crisis. We had a need. We were a very special company in the right time, in the right place.
I had dinner with a minister from a Middle Eastern nation, I won't say who. And during dinner, he was convincing me that the U.S. government was going to shut down Bitcoin.
When?
This was 3 months ago.
Okay. Yeah, I think that the biggest challenge of Bitcoin is that the industry refers to it as a cryptocurrency, and oftentimes people refer to it as a digital currency, and there's a very vocal contingent that wants it to be a currency, and the rest of the world doesn't really understand money. So that being the case, let's view this from first principles, right? Money's economic energy. If you want to store your economic energy, you put it in assets. And the assets have different half-lives with which they store the energy. Any textbook economist will say money is a store of value, medium of exchange, unit of account, and they stop, and they don't really think much beyond that, and then they'll bark at you that you don't have money because you don't have, this is not good for a medium of exchange, but nobody really thinks about what they just said. So if you thought about it, you would realize that about 120 currencies in the world are mediums of exchange. The peso is a medium of exchange, the naira is a medium of exchange. So weak currencies, the Turkish lira, the Lebanese pound, they're mediums of exchange. You can find a lot of them. The Venezuelan bolivar, medium of exchange. But if you go to South America, you'll find that it's not a unit of account. If you go to Argentina, the unit of account is the US dollar, and they think in terms of dollars. So there are only 3 currencies in the world that are units of account. They're the euro, the dollar, and the CNY. And so why is that? Because the mediums of exchange are weak currencies inflating at 14 to 24% a year. They're losing their economic energy over 3 to 5 years. The half-life of the money in the asset is about 5 years or less. Sometimes it's only 5 months. Like in the naira, they lost 75% of their energy last week. So the medium of exchange only is dictated by the government as legal tender. Every government that's functional will dictate their currency as a medium of exchange and enforce that. The unit of account is generally the dollar, the euro, and currencies pegged to the dollar, and the store of value, well, nobody in the United States thinks the dollar is a store of value, no rich person. if you look at wealthy people, they would say the story about if they're really wealthy, if they're billionaires, they own buildings, blocks, huge properties, or they own the Patriots. They own a sports team, a soccer club, or they own a collection of Picassos. That's what the wealthy use as store of value. The middle class store of value is the Vanguard 500 or S&P index. It's SPY. It's basically been the S&P or QQQ. It's basically a diversified portfolio of stocks, and that's been the status quo since 30, 40 years ago when Bogle did that. So the world today consists of 120 mediums of exchange, about 3-4 units of account, no currencies or stores of value. And if you say to someone, what do you think about Bitcoin as digital currency? They say, well, I think it threatens the dollar, I hate it. If you said, what do you think about Bitcoin as digital property? You know, I'm going to buy it instead of buying a building in Des Moines. They're like, oh, have at it. If you simply conceptualize it as property, or which is store of value, all of the objections, all of the straw man objections, like it's used for money laundering, it's not legal tender, I can't buy coffee with it, it's not fast enough, it's not private. All of these things disappear because it's about as stupid as saying to Bob Kraft, you can't buy a cup of coffee with the New England Patriots by breaking off one of your tight ends. And you can't buy a cup of coffee with your building in Boston. So of course I can't. You can't buy a cup of coffee with part of a Picasso, the lower left corner either. But wealthy people have been using them as a store of value and as money for 500 years. And
let's talk about real estate as a store of value. It too can sublimate.
Yeah, so when you say,
I mean,
what is the question?
What
do I think of it?
Real estate itself as a store of value.
So what I think is, of course, if you just describe Bitcoin as digital property or store of value, all of the popular criticisms would go away, and everyone that hates Bitcoin would completely flip once they understood it isn't a currency. So people just ought to say it's a property, it's not a currency, and every one of those criticisms and weaknesses is no longer relevant. What I think, the second thing I say on store of value is, it's kind of silly to fight to be a digital currency because there's $900 trillion of wealth in the world, 400 trillion of it wants to be store of value, only 1 trillion wants to be a medium of exchange. Go to a wealthy person and ask them what percentage of their wealth is in their checking account. It's like 1%, maybe. No wealthy person is holding more than 1% in ready cash. So it's not even worth fighting for. Like, you can fight the government to be a currency, but you're just fighting someone that's got guns and police force, etc. The store of value is the use case that matters. And another word for store of value is property. And the third word for store of value is capital. And if we just thought this is digital capital, now you get the profound idea, right? Which is there's capital in the economy. Where is it sitting? Well, it's sitting in buildings. We monetize buildings. A rich person goes and I know a lot of wealthy people. They make a fortune, and what they do is they just go buy real estate that they don't need. They buy apartments they don't need. I mean, everybody can pick up the paper and they can see examples. People buy trophy assets and they buy buildings and they buy land they don't need. Land buying things. So real estate is a way to fight inflation or to preserve capital over the long term. Another way to do it is I invested in a company, or I attempt to pick the right stock, a Magnificent Seven stock. A third way to do it is with art. I mean, Velázquez in the 16th century travels from Spain to Italy. He wants to buy all the great art, and he's got the King of Spain's checkbook and an infinite budget, and he complains nobody will sell him the art because all the rich people in Italy are using it as store of value so they can flee with their portable, scarce, desirable property when they have to leave town, or they're using it as an inflation hedge. And I kid you not, go read Will Durant's history of the Renaissance, and he notes It's an inflation hedge and a store in value 500 years ago. So that's the way people think. Why is Bitcoin better? It's better because the problem with storing billions of dollars in a building is the building can't run and the building can't hide, and everybody knows a rich person owns the building and therefore we're going to tax them. I mean, I just give you a simple question. I'm going to give you $1 billion right now. I'm going to drop you in Africa. What building in Africa are you going to buy in what country and hold for 100 years?
Yeah.
Like there is, not to disparage Africa, there's not a single piece of real estate in a single country in Africa that any of you would be wise to purchase if you had to hold it 100 years. On the other hand, if you held $1 billion worth of Bitcoin in Africa, you'd probably still have the money 100 years from now. And if you lost it, it's because you lost it, not because it was taken from you. Everybody walks past the biggest tower in the city, and they look up and they say, there's a person with more money than me. And then they think, why don't we tax them? What are they going to do, move the building? Right? You're not going to move the building. And so then they walk past the parking lot, and they think, well, let's just go ahead and put a zoning restriction on that so you can't actually build on that parking lot. So at the end of the day, your property is getting rent controlled, expropriated, taxed, etc. And so it's the best idea in the 20th century.
Yeah. I think that's the important point.
But we're not in the 20th century, we're in the 21st.
I wanted to get that point across because a lot of people think about real estate as somewhat, unique real estate on the beach, on park, on Central Park, but it has those issues. I'd like to take the conversation to Bitcoin as a technology, Lightning rewards. Some time ago, you spoke about a Bitcoin Lightning reward mechanism out of MicroStrategies, which I thought was brilliant. Would you go there?
Well, I think Bitcoin layer 1 is all about creating monetary integrity and in the base layer, and it's meant to be a settlement network for high-powered money. So, in essence, where you see it going is trillions and then hundreds of trillions of dollars in a network. It needs to be extremely robust. But the way you get robust is you create a block every 10 minutes and you put thousands of transactions every 10 minutes. So it's destined to move blocks of money $10 million at a time, $100 million at a time. And for that, it's pretty good. You can imagine banks, corporations settling with each other at that speed. And if you want to move $1 billion from New York to Tokyo, spending $10 seems pretty cheap, and doing it in half an hour is not a big deal. But if you want to get to transactional applications, you can't do it on the base layer. There's two approaches. One approach is you change the base layer to give it higher throughput, but the problem with that is that you're changing the underlying scarcity parameters, which undermines the stability of the system and the integrity and the security of the system. So ultimately, you make the network more fragile, and so most things don't scale all on one layer. You scale in layers. So Lightning is the most famous of the layer 2s, and really it's an example of an open protocol layer 2 system that sits on top of Bitcoin, and it's channel based. So the idea is, if I want to move $10 back and forth 1 million times an hour, I probably don't need to put the entire $1 trillion network at risk. I could probably just set up a channel that had $5 million on this side or $5 million on this side, and I could move back and forth, and then I'll settle on the base layer as I open and close the channels. So the brilliance of that approach is you're still using Satoshis or underlying Bitcoin as gas. So you've got an ethical network and an economically sound network, but you've created an infinitely scalable network, because once you go to this channel approach, there's no reason why you can't clear millions of transactions a second. And so Lightning is the layer 2 to clear millions of transactions a second thing. The idea of Bitcoin rewards is if you want to give people small micro payments or very, very rapid payments for engagement, you show up to a meeting, you get rewarded with something of monetary value. You come, if I want to come to offer people a reward to come and register my website, I do it using an open network that isn't subject to the constraints of the fiat credit system.
I do imagine that we're going to very quickly head to a world where everybody's got a digital wallet and is transacting in the same way we have a leather wallet in our pocket. And I love the vision that you had. Like if you show up for the HR meeting on time, you get a certain number of Satoshis. If you turn in your report on time, if you perform at this level, so you get what you incentivize. And the idea that this is an incentivization process. I keep on waiting for X to announce wallets and an incentive plan like that.
There's a profound statement made by J.P. Morgan 100 years ago. He said, gold is money, everything else is credit. And just like first principles,
at least back then.
Most people don't understand what money is. Money's a bearer instrument. Most people don't understand what credit is. Credit is when you have an IOU from a counterparty and they may or may not honor the IOU. So what we have today in the internet is you have a lot of profound applications that are digital transformation of information. We have figured out how to digitally transform photos and music and books and things like that. But we haven't implemented digital money. So whenever you pay anybody on the internet, you're paying with credit, not with money. And the problem with paying with credit is Visa, MasterCard, your bank, the correspondent bank, the central banks, there's a stack of 7 counterparties in between me and you. And that means that if I wanted to give you 50 cents, let's just say I want to move any amount of money around. If I want to move $1 around, every time I move it, there's a 30 to 60 day settlement delay, and there's a 2.5% fee. So when I move the money 40 times, it took 48 months. It takes 4 years to move the money from 40 people in the room. If you just started moving any amount of money, it would be 4 years before it finally settles, and all the money would be gone because it would be like 100% commission you would pay to the banks. So the problem with the credit networks are they're brittle, they're slow, they're expensive, and by the way, if you're an AI bot, you can't get a credit card. And if you're, so robots aren't people, AIs aren't people, but and I'm going to make fun of them because Bitcoin gives AIs in cyberspace sovereignty. If you want to release a service powered by an AI into the ether, outside the control of a person, a government, a company, you're going to need to finance it with money, digital money, which means Bitcoin. So AIs aren't people yet, and Bitcoin will give them sovereignty of sorts, but people aren't people. Because 6 billion people on the planet, they don't have credit. Like, I dare you to try to send money to someone in Africa on Saturday, or try to cross borders. Try to send some money to someone in China, see how it works out, right? So, and by the way, that's the countries shut down at the border, but even within each country, most people, a lot of people don't have credit card. So, Bitcoin is money. Everything else is credit. And you cannot build the 21st century cyber economy if you don't have money. Money needs to move at the speed of light, and Lightning is an approach. There's a bunch of other approaches.
So, Bitcoin is the financial side of the internet that didn't exist in the 1990s. Right?
The profound big idea is Google, Facebook, Apple, Amazon, they made all their money based on the digital transformation of information apps, which are non-conservative. In the thermodynamic, physical sense, they are non-conservative. I can give every one of you my music file. Whereas We're now moving into a new transition. I think it's a 30-year transition. It's digital energy. It's digital energy, digital money, digital capital, digital property. These are all just different words for things that are conservative in cyberspace. If I give you $1 billion, I have to lose it. I can't give everybody $1 billion, right? There has to be a conservation of energy or conservation of money here. And none of the great companies have been built on digital energy or digital monetary apps. But if you think about the next set of applications, the ones where I can take a block of $1 billion of capital in cyberspace and I can decompose it to 1 million smaller blocks, send it to 1 million different places in 1 hour, recompose it 3 hours later, chop it into a bunch of $10 segments, pull that back, oscillate it, program it, transfer it, or just store it for 50. How do you store money for 50 years? Right? And the metaphor I give you as an aeronautical engineer, which I think Elon would like, and I think you'll like, is it's the difference between you launch something and it goes ballistic and comes back to Earth.
Suborbital versus orbital.
And you launch it and it reaches escape velocity and it goes orbital. One is in space forever, and the other's in space for a blink of an eye. And what we're trying to do is put energy in cyberspace, or put money in cyberspace, reach escape velocity such that it lasts forever with zero friction. It's like superconducting.
So let's talk about the path towards what seems to be inevitable, for which there is tremendous social disbelief, institutional resistance, manipulation, right? So let's say the decade of 2000 to 2018, 19 was still the very entrepreneurial, highly risk area. We start to have adoption by wealthier individuals, and we finally moved into institutions, the release of the ETFs. And I talk about going from deceptive to disruptive, and we're in that near the curve, right? I mean, so this is an example in the 60s, right? We've digitized money, you've dematerialized it, right? You effectively demonetized the ability to transmit, and you've democratized access to it. And it's going from deceptive to disruptive. What is is there a final card to flip, domino to fall? Is it governments beyond El Salvador adopting this?
I think 2020 to 2024 was, high volatility, high uncertainty. It's like that early stage of institutional adoption, but really, we start mainstream institutional adoption, I would date it to January 2024 with the approval of the ETFs, the spot ETFs. And I think it runs, we have about a 10-year gold rush. It runs to 2034 November. Between 2024 and 2034, we will have mined 99% of all the Bitcoin. So Bitcoin becomes, for all practical purposes, fixed by November of 2024. The last 1% comes out over 100 years. Okay, so we have this 42-quarter period where at the beginning of the period...
What percentage are we at now?
Right now we're like 94%.
Wow.
So you think it's not much, but I mean 5% is a lot over 10 years compared to 1% over 100 years. So there's actually still Bitcoin available for sale right now. The miners have to sell it. So at the beginning of this period in Q1, we're in Q1 now, if you go to January 1st, no institution could buy it even if they wanted to. It just wasn't on their radar. And so you really have 42 quarters of people learning what it is, studying it. It takes 10 hours to scratch the surface, and it takes 100 hours before you get a degree of comfort. Most people, once they get past the age of 40, they don't want to spend 100 hours learning a new thing. It's very rare. So You've got Wall Street firms spinning up massive education apparatus. You've got a whole set of stages of adoption. First, can I buy it? Then is it on the approved list for solicited sale? Then it is on the approved list for unsolicited sale. Is it marginable? Can I borrow against it? Is it optionable? Can I hedge it? Is it recommended? Is it structural? Is it built into a fund? That's like 7 layers of adoption. People take a year to think about each of those layers. There's 100 powerful entities that control huge amounts of money that will go through that in the Western world. So I think we're in this institutional education stage. And in 2034, it'll simply be the new thing. Right now, it's like the scary, exotic thing for most people.
Yeah, it's interesting. My mom asked me what she should be doing with her her mandatory distributions, and I said, buy the Bitcoin ETF. Right? Talk to me 1 second about, I don't want you to give financial advice, but I do want you to speak to, how do I put this? How should a person think about what percentage of their wealth they put here?
I think it depends upon where you live, who you are, and what your life situation is, and also whether you're a corporation, a charity, a government, a family, an individual. That matters too. So for example, if you were asking me for that advice for a business owner in Nigeria right now, I would say most. I would say, the question you got to ask yourself is, can I trust the government? Can I trust the bank? Can I trust the currency? And can I leave with my stuff? So if you're saying to me, Mike, should I buy a building in Nigeria, or should I buy a business, or should I buy a diversified portfolio? Would I recommend a diversified portfolio of Venezuelan stocks, or a diversified portfolio of Cuban stocks? Like, it really depends on where you live. North Korea, Cuba are kind of simple. All through Africa. If you lived in Egypt, the currency's unwinding. If you follow the Turkish lira has gone from 7 lira to the dollar to 32 lira to the dollar in 36 months.
Let's make believe we're living in the U.S. or a European.
Okay, and if you're 70 years old and you're retired and you don't expect to ever have to flee for your life, then you probably should buy the ETF. And if you're 20 years old and you've got your entire life ahead of you and you think you might want to relocate to a different country and you can't predict it, then generally you're better to buy the underlying asset. Some people should buy the Bitcoin in self-custody. Some people should buy the Bitcoin and they should institutional custody. Some people should buy the ETF. And then if we flip the companies, there are companies where it's illegal for them, to say self-custody. There are companies where, there are investment companies where they can't buy certain commodities, but they could buy securities. So the real issue is, what's the entity, and then what's your time horizon? And as a general rule, the longer your time horizon, the more you would prefer to hold the money, the underlying commodity asset, because if you hold the asset, you can transfer it to any counterparty in the world, you can custody it anywhere, you can self-custody, and it doesn't come with a taxable event.
Let's make believe you're speaking to 400 CEOs in the room who are asking the question about, I've got...
Okay, I'm going to give you a very simple observation. Everybody looks at Bitcoin and they think, well, how do I create the next Cash App, or the next mobile app, or the next Fidelity, or the next Coinbase, or the next whatever? And they think really hard about that, or how do I topple JP Morgan? It's like, that's a very difficult thing to do. I give you a very simple idea. You have a treasury in your company. If you put your treasury into sovereign debt, you're going to yield 5% pre-tax, 3% after tax. and you're not going to beat the cost of capital. The cost of capital right now is 8 to 10% in the US, easy. So if that's the case, your treasury is a liability, which means that any rational person would look at you and say you should decapitalize, you should run on the minimum working capital or negative working capital, and you should run on debt. But I'll give you another idea. If you actually are investing in something you expect to go up 20 to 40% a year for the next decade, you're beating the cost of capital by a factor of 2. That means the right thing to do is go back to your venture capitalist or your bank and just raise $100 million that you don't need and buy Bitcoin with it. Because if the business you're running doesn't work, you will have a business that's growing 20 to 30% a year scalably for the next 30 years. That will work, right? You'll double the 100 million 2 times in the next 6 years. So you'll be 200, 400 million. In 6 years, when the thing that you're doing right now doesn't work, you're going to have a business that's growing 20% a year off a $400 million base, which is a monopoly. So I think the number one, I mean, this is a simple hack, but every venture capitalist in the world is getting 2 and 20. They're getting a 2% management fee and a 20% participation. And their mandate is they have to invest in operating businesses that are private. And if they were to go and buy $1 billion of Bitcoin with limited partner capital, their limited partners would say, are you crazy? I could have bought the Bitcoin. So the VC can't buy Bitcoin, which is the risk-free return of 20, 30% a year. The VC can give you the $100 million. You can buy the Bitcoin. They end up with debt in a private company. You end up with $100, $200, $500 million business growing 20, 30% a year that's scalable that you run with yourself and your CFO. It's good for them. They're going to make a fortune. They want to invest the money. The real problem in the world, and by the way, this is back to the Tao of Steve. In the Tao of Steve, there's a guy sitting on the bed and he's smoking marijuana, and someone's saying, well, you know, like, why aren't you out there doing something? He says, doing stuff is highly overrated. Okay? So here's the big idea, which is there's a couple $100 trillion of capital in the world that's debasing at 10% a year right now. And the big idea is just stop investing in toxic money, right? If you simply flip your treasury to something accreting at 10% a year. You see, it's like everybody wants to they want to hire 100 people and do a lot of stuff that's risky, but really, this is very painful, but if I told you the water that you're giving your kids is toxic and it's full of pathogens, and that's why half of your children died, and you said, well, what's the big idea? I would say, give your kids clean water. Is that easy? Yeah. And if I said the food, well, the food's not cooked and there are worms in it and pathogens, and that's why you're dying. What's the big idea? Eat clean food. Right? I mean, the whole idea is, what about clean air? Clean air, clean the food, here's the one. All my doctors, they want to give me bad drugs and bleed me whenever I sneeze. What's the big idea? Stop taking the bad drugs and stop letting them bleed you. Okay, so if you're running a business and you're running a business on cash, the cash is losing 8% of its value a year. You're basically bleeding out energy on your balance sheet right now. And the simple idea for max performance is turn your balance sheet into an asset. Anybody can do it. And you know, what happens? Well, the MicroStrategy story is we had a $600 million enterprise value with $600 million of cash, which was a liability. What did we do? We flipped it to be $600 million of Bitcoin and a $600 million enterprise, and then the Bitcoin kept growing. And the Bitcoin's been going up 40% a year. Bitcoin is going, I can't tell you what it will do, but I can tell you it will outperform the S&P 500 over time. That I'm quite sure of. So you flip your balance sheet to become an asset, and today the enterprise value of the company is $30 billion. You know, the stock's up by a factor of 10, the equity market cap's up by a factor of 20, and the enterprise value is up by a factor of 40. It took 42 months. Not 4 years. I haven't graduated from my senior year in Bitcoin. I'm halfway through my senior year in Bitcoin. But the profound idea is every company in the world has toxic assets on its balance sheet. They're all liabilities, right? And we taught the conventional wisdom in corporate finance is if you have capital, give it back and dividend it out. Facebook is buying back 50 billion of their stock and dividending out billions of their stock. Apple is buying back their stock and dividending out their stock. Scratch your head and think about this a second. I'm going to apply this to Harvard and MIT. Give back the endowments and just raise the cost of the tuition 20% a year and stack twice as many students per class, and that's how you fix the university. Right? No, right? How about this as an idea for your family? I want you to take all the money your family has, I want you to give it away to charity, and I just want you to tell your wife, your husband, your kids just to work harder and ask for a 15% raise next year. And that's how you're going to fix your family. You see, they're both pretty silly, right? And like, you would never in a million years have that as your strategy. We give up all the capital and we work harder. But you know what the corporate playbook is? Give up all the capital, raise your prices, work harder, grow your cash flows by 15% a year, and then you'll be fine. And that's why 99% of the companies fail. That's why the life expectancy of a corporation is 10 years. And you know what? I mean, Harvard, Oxford, Yale, they lasted more than 10 years. Did they do it by raising their prices 10% a year and working harder? No. In fact, there's not much productivity boost in any of those places in 500 years. So here's the profound idea, which is, if we adopted a different financial model in corporations, you could have companies last for hundreds of years. You don't have to die, right? For example, you're a dentist. Why do I have to raise my prices 10 or 20% a year to be viewed as successful as a dentist, right? It's because, I'll tell you why, because we keep expanding the currency supply by 10%. Which means the price of everything you want to buy goes up by 10%, which means you have to grow your cash flow by 10%. And that's why the Magnificent Seven generate all the returns in the S&P 500, and there are 493 companies that return nothing. Zero, right? And by the way, it's not their fault, right? We blame them. We blame the companies like we blame the workers for not working harder. It's not their fault. You cannot outwork inflation. And we're back to this issue of, if the person that runs the currency or the money printer just keeps printing 20% more money or 10% more money a year, you just stop the heart. You basically create a heart attack for every worker in the economy. And so my advice to anybody who's a CEO is, don't work harder, work smarter, but really, you're in a rowboat, you're trying to row, the wind is blowing, get yourself a sail, put the sail up, and let the wind blow you, instead of trying to row across the Atlantic. You're not going to make it.
How many folks here right now, in the back of their mind, they're thinking, as soon as I get home, I'm going to look at putting a chunk of my treasury or a chunk of my personal into Bitcoin? Can you raise your hand if that's a conversation that you're having with yourself right now? So, right, in 2014, I gave everybody in the room here Bitcoin as a gift. We had a Bitcoin ATM, and you have no idea how many people came to me years later saying, remember that piece of paper you gave me? Can I have a copy of it? No. But you're getting the equivalent right now. Right? You're getting the equivalent right now. Which is to say, if you can appreciate the logic here, the first principle thinking that Michael is putting forward, then you probably are thinking about going back and making that change. Now, the degree to which you want to put some or all of your treasury, or some of all of your cash, or some of all of your stocks into Bitcoin is up to you. But I am curious, and I will ask you next year, or maybe in the next meetup that we have, how many did that. And then we'll see a year from now, or 5 years from now, how many billions of dollars that was worth to the room. That'll be interesting.
The low-risk way to do it, Pete, is you just go to a venture capitalist, and next time you raise $50 million in capital, raise $100 million in capital, and then put $50 million into Bitcoin, and the other $50 million to whatever. I mean, how many people in the room have a business they think they can grow 20% a year every year for the next decade without taking any more capital, without a capital investment, without hiring another person, without taking competitive risk? Like, if you're honest with yourself, no one's sure they can do that. There's like 7 companies that have done it: Google, Facebook, Amazon. We know their names because for every one of them succeeded, 10,000 companies failed. It is statistically very difficult. But on the other hand, so when you invest in Bitcoin, it's probably the least risky thing you're doing. But I'm not telling you, by the way, the big idea is not just take every last penny and buy Bitcoin. The real big idea is that they're venture capitalists like SoftBank with 10 billion, 20 billion, 50 billion. Their problem is they need to invest the money, right? They need to invest the money. They need a use of proceeds. And Bitcoin is the world's greatest use of proceeds because it's accretive, it beats the cost of capital, right? And name a sovereign debt does not beat the cost of capital. Cash does not beat the cost of capital. You can't, by the way, you can't do this with arts. You can't do it with real estate. I mean, the closest thing would be, I'm going to raise billions of dollars, I'm going to buy high-quality real estate. And so that's a real estate development thing, but that's a 20th century idea, and we're in the 21st century, and you need to think about cyber real estate.
We're going to go to about 20 minutes of questions. If you have a question, please go to this microphone. Microphone's here.